Hey everyone, Ray here from S Mortgage. Hope you're having a great day out there. And today is Bank of Canada rate announcement day. And with that, they've released the monetary policy report, which contains a ton more information on the metrics and insights as to how they go about making their decisions and the factors that influence the Canadian economy going forward. And I think it's safe to say we've entered the hurry up and wait phase. We eagerly anticipated March's rate announcement just 6 weeks ago and getting that first break from a consecutive string of rate increases and giving us a little bit of room to breathe. And today that pause continued. What's interesting is that the Bank of Canada did alter their language a little bit. So, right, we've heard the phrase conditional pause that was perpetuated in the March announcement. And today they removed that and inserted language instead that said, in effect, we will judge if the policy rate is high enough, which introduces the threat or reintroduces the threat of potentially further rate increases. Now, is this more a psychological battle for them, or is this a realistic threat, to see further rate increases? And of course, there is always that potential, but I think it probably falls more on the psychological side because what the Bank of Canada is facing right now is a surprisingly resilient Canadian economy and probably a consumer that's a little bit more confident than they should reasonably be, right? We've had jobs added continuously. GDP growth surprised to the upside, and consumer spending has proven to be surprisingly resilient, while expectations of inflation still are probably a little bit higher than the Bank of Canada wants. So they probably want to strike a little bit of fear to combat that. On the other side, we have inflation starting to drop and expected to drop further. We have global indicators of recession rising. So there are some threats of the pain yet to come. And we know that these interest rate increases take up to 18 months to take effect. So we can realistically expect that the full effect of these increases has yet to be felt. So there's probably still a bit more pain to come. Now, how we get from where we are today to the first rate drop and the official changing of the cycle is going to be an interesting one. And I think if the Bank of Canada could wave a wand and flash us forward 6 months, they gladly would, because their language over the next 4, 5, 6 months is going to be heavily dissected. Every announcement that comes out is going to be analyzed 6 ways till Sunday, trying to find clues and guidance as to what happens going forward. But I think from here, the missing ingredient here is time. The language will try and control the narrative a little bit and adjust the expectations of consumers. But realistically, I don't know that we can expect a whole lot, barring any sort of crazy changes to the economy or in the world. So watch out for that. But I think we're going to be having these conversations a little bit more consistently that points towards the likelihood of the next move being a drop. When that happens, currently being priced into the end of this year, remains to be seen. So we'll keep an eye on those things. And as it comes, we'll keep you posted.